In this video, we are going to talk about investing for beginners, a step-by-step guide. So before starting this video, please like this video and subscribe to our channel for future updates. Investing means buying securities, which is an investment, like stocks, bonds, mutual funds, and exchange-traded funds, ETFs, to make money as they grow in value over time. Investors generally create a portfolio made up of these various investments and often hold them for years or even decades. Traders, on the other hand, generally buy and sell investments rapidly to generate many small profits as prices rise and fall. If the idea of day trading makes you sweat, rest assured, investing is generally much simpler and less stressful. Remember that investing should be a marathon, not a sprint. Here's how to get started. Number 8. Define your investment goals. Learning how to invest starts with a crucial step: defining your investment goals. It's about understanding why you want to invest and what you hope to achieve. Are you saving for a comfortable retirement, a down payment on a house, your child's education, or something else? Defined goals help new investors stay focused and motivated, especially during market fluctuations. They act as a compass, guiding your investment decisions and helping you measure progress. Each goal will have a different time frame and risk profile. At Stash, we believe in the power of goal-oriented investing. It's not just about growing your wealth, but aligning your investments with your life's objectives. When you have clear goals that matter to you, you can tailor your investment strategy to match them. Number 7. Make sure you're ready to invest. Before you start investing, you may want to first determine if you're ready. Here are some indicators that the time may be right. Disposable income. If you can pay all your bills with a bit left over, it might be time to put your dollars to work. If you're not currently budgeting, now is the perfect time to get started. No high-interest debt. Let's say you earn 5% on your investment, but you owe 18% interest on a credit card balance. That cancels out your return, and then some. So paying down high-interest debt before you invest may be a good option. An emergency fund. Do you have 3 to 6 months of expenses in savings? If not, tying up all your extra cash in investments might force you to liquidate fast in case of an emergency, which may cause you to lose money on your investments. Even if you have $1,000 to invest, it may be better to put that money toward things like high-interest debt and an emergency fund if those aren't in place yet. Number 6. Set up your investment budget. If you're ready to invest, the next step is to decide how much you can afford to invest. It doesn't have to be a large sum. Even small, regular contributions can grow significantly over time, thanks to compound interest. In fact, with many online brokers, you can often get started investing with as little as $1. While shares of stock and other securities can be costly, many brokerages sell them by the slice via fractional shares. Once you start investing, you'll likely want to keep adding money to your accounts, especially if you have long-term goals like retirement. Many experts recommend investing 10 to 20% of your income on an ongoing basis. But these are guidelines, not hard rules, and you can build up to this savings rate over time. Number 5. Choose the right investment account. The next pivotal step in your investing journey is opening an investment account. But it's not just about picking any account. Your choice should be guided by the goals you've set. For instance, if you're saving for retirement, you might choose a tax-advantaged individual retirement account, IRA. If you're saving up for your future dream house, you might consider a standard brokerage account. There are several types of investment accounts to choose from. Taxable brokerage accounts. A brokerage account allows you to buy and sell virtually any investment. Adults can also create custodial accounts for children. Employer-sponsored retirement plans. This category includes 401, 403, SEP individual retirement accounts, IRAs, and simple IRAs. Many workplaces offer an employer match, which is essentially free money for your retirement. Individual retirement accounts, IRAs. If you don't have an employer-sponsored plan, or if you want to invest more, a traditional or Roth IRA can help you save for retirement and reap tax advantages. 529 Education Savings Plan. Saving for your child's education, a 529 savings plan may offer flexibility and tax advantages. Number 4. Think about your risk tolerance. All investment involves risk, including the risk that you could lose money. But how much risk each person is comfortable with is very personal. Your age, income, financial goals, and other factors play a role. Investors typically sort risk tolerance into 3 categories. Conservative. A conservative investor values stability over the potential for higher investment returns. Asset allocation is likely to be 40% stocks and 60% bonds. Moderate investors aim to balance stability with higher reward potential. Typically, they allocate 60% to stocks and 40% to bonds. Aggressive investors feel comfortable taking big risks and hope to earn big rewards. They usually allocate 80% to stocks and 20% to bonds. It's vital to know your comfort level. Are you okay with high-risk, high-reward options? Or do you prefer a safer, steady growth approach? Are you getting closer to retirement age? Or do you have decades to go? Your risk tolerance will influence the types of investments you choose, balancing potential gains with the possibility of losses. Number 3. Choose your investments. In this next step, you'll choose investments based on your goals and risk tolerance. There are many types of stock market investments available. Most everyday investors put their money in stocks, bonds, mutual funds, or ETFs. Cryptocurrency is also becoming a popular investment option, although it is a very risky investment. Additionally, you can even invest in real estate through a real estate investment trust. For beginners, index funds and mutual funds can be a great way to start as they can offer built-in diversification and lower risk. Stash can guide you in choosing investments that match your financial objectives and risk profile. There are following investment type: stock, bond, mutual fund, exchange-traded fund, ETFs, and cryptocurrency. There is tremendous variation within each investment type. Value stocks, for example, tend to be relatively stable, while junk bonds can be quite risky. That's why it's important to research stocks, funds, and any other investment options before investing. Number 2. Decide your investment approach. DI or robo-advisors. As you learn how to start investing, another critical decision you'll make is whether to manage your investments yourself, DIY, or use a robo-advisor. Each approach has its benefits and considerations. DI investing allows you full control over your investment choices. You can select individual stocks, bonds, ETFs, and other assets based on your research and preferences. It requires a commitment to learning about financial markets, investment strategies, and how to monitor your portfolio. It's ideal for those who have a keen interest in financial markets and want to be actively involved in managing their investments. Robo-advisors use algorithms to manage your investments based on your goals and risk tolerance. They automatically allocate your funds across various assets and rebalance your portfolio as needed. Automated investing is great for beginners or those who prefer a hands-off approach. It eliminates the need for extensive market knowledge and ongoing portfolio management, saving you time and effort. Number 1. Monitor and adjust your investments. Once you've laid the groundwork and made your investment choices, you're officially investing. You no longer have to figure out how to start because you're doing the thing. But remember, investing isn't a set-it-and-forget-it activity. Regularly review your investments to ensure they align with your goals and make adjustments as needed. Market conditions change, and so might your financial situation or goals. Consult a certified financial planner for personalized advice on how to use investment funds to reach your financial goals. When you first start investing, it can feel overwhelming, but it doesn't have to be complicated to begin putting your money to work. The Stashware can help. It's all about investing what you can afford on a regular basis, building a diversified portfolio, and investing for long-term growth. So this is our today's video. If you like our video, don't forget to subscribe to our channel or hit the bell icon. We will meet again with another interesting topic. Till then, stay safe and stay happy.